Welcome to the Retiring Canada podcast, where our mission is to educate and empower you to make the most informed, rational, and productive financial decisions. Hosted by certified financial planner, author, and chartered investment manager Michael Isbister. You'll go behind the scenes to uncover the tips and strategies to help you invest smarter, optimize your retirement income, and reduce the amount of tax you pay. Michael is an investment advisor with Fundamental Wealth, a trade name of Harbourfront Wealth Management, a CERO dealer. And now, here's your host, Michael Isbister.
Hello everyone, and welcome again to the Retiring Canada podcast. In today's episode, we're going to discuss the 7-step blueprint for tax-wise retirement income. Specifically, I'm going to chat about the chess match that is retirement planning, 7 considerations to create a sustainable retirement income for life, a significant income loss you may experience later in life, 2 key points to consider while both spouses are living, the art of retirement planning, and lastly, as always, a few action items for you to consider. Retirement planning is like playing chess. Both require strategy, forethought, and flexibility. As the pieces on the board change, so too does your strategy. A lot of the same can be said when it comes to developing a tax-efficient retirement income plan. Retirement planning is an ongoing process that is shaped by changing personal circumstances, evolving tax rules, and market conditions, to name a few. And the personal nuances to each and every individual and family only further drives home the point that no two retirement plans are exactly the same. We also understand that the best laid plans can change year over year. So the plan you developed the year of your retirement may be suitable today. However, there is a very strong chance a lot will change throughout the course of your retirement, and you need a plan that is nimble and can adapt to life's circumstances. The importance of annual reviews and flexible strategies for decumulation are the hallmark of creating a tax-wise retirement income plan. We call our process the Fundamental Retirement Plan. So today, let's cover off 7 key considerations you need to factor into your retirement planning to create a sustainable retirement income for life. Number 1, have a decumulation strategy. In this podcast, I talk a lot about decumulation. I believe many retirees are underserviced when it comes to developing these kinds of strategies, so this is where we will start. Decumulation is another way of saying, in what order will I draw out of my retirement accounts to fund my retirement lifestyle? This is also sometimes referred to as your order or sequence of withdrawals. To start, you need to understand all of your sources of income, starting with your fixed pensions from your defined benefit pension plans, annuities, Canada Pension Plan, and OAS. Once you understand the fixed amounts you can expect, we want to fill in the gaps from your retirement accounts, RSPs, RIFs, unregistered accounts, to create a sustainable retirement income. During this process, you'll also want to have a very strong understanding of what your CPP and OAS amounts will be if you're not currently receiving them. This information is crucial to your decumulation strategy. Perhaps you and your spouse have significant taxable accounts, RSP, defined contribution plans, etc., with very little tax paid dollars. In this scenario, maybe it makes sense to delay government benefits to quote-unquote free up some money from your taxable accounts to provide easily accessible tax paid dollars later in retirement. Which brings me to consideration number 2. Timing of government benefits. Choosing your CPP and OAS start dates are arguably one of the most crucial decisions you will make leading up to and entering retirement. Taking your CPP before age 65 means you will have a permanent reduction to your benefit. Delay CPP and OAS after age 65 as far out as age 70, and you will receive a permanent increase to your benefits. Chances are you already know this. But what you might not be considering is how the timing of these benefits also impacts your RRSP/RIF accounts, your taxes payable today, and tax payable in the future. The CPP and OAS start date decision should never be made in isolation. How your investment accounts are set up, the mix of accounts you have between you and your spouse, and even how you are invested all impact this decision. Have north of $1 million in RRSPs? Maybe delaying makes sense. Is there a 5+ year age difference between you and your spouse? Maybe a staggered start would be best. Do you expect a significant inheritance from an aging parent? How will this impact your income and taxes in the future? Are you looking to sell a rental property in your late 60s? Would a capital gain push you into an OAS clawback scenario? I could go on and on with unique planning scenarios that require a personalized approach and a retirement plan created by a certified financial planner, not just investment suggestions. Next up is number 3, tax-efficient retirement income. As you're probably understanding by now, all these decisions are interconnected, and the decisions you make or choose not to make will ripple throughout your retirement. When creating a tax-efficient retirement income, one of the first things we consider for clients is planning during the tax valley. You've probably heard me reference this in the past, but as a refresher, I consider the tax valley the time between your retirement start date and the beginning of your fixed pensions or income, specifically your government benefits, defined benefit pensions, and annuities. This is the time where we may consider enhanced drawdowns on your registered accounts while delaying these fixed pensions. In doing so, you will enhance the future benefit of your government pensions while reducing the lifetime tax liability of your registered accounts. For those of you with a corporation and RRSP accounts, we tend to focus on drawing down the registered accounts while deferring the corporate income as best we can. There will undoubtedly be some notional amounts, whether it's the refundable dividend tax on hand, capital dividend account, or shareholder loan repayment, that will still take place year over year. But we want to account for this by having a direct discussion with your accountant to ensure and align your drawdown strategy. For those of you with a spouse, we always want to add in the nuances of pension income splitting, CPP sharing, and potentially the potential use of a spousal loan for those who've had a large taxable event and are now sitting on a large pool of cash personally. At our firm, during the fall of every year before we meet with our clients, we curate a customized tax estimate for the year. This estimate factors in all of their sources of income and looks for ways to mitigate taxes in that year and on a go-forward basis. Oftentimes, we may consider strategic rebalancing to optimize capital gain and loss positions, while in other scenarios, we may draw a larger amount out of one spouse's RIF account to income split back to the other spouse, thus getting funds out of a taxable account at reasonable rates and freeing up tax-paid dollars to invest or spend later in retirement. This is a balancing act that we review and refresh every year for our clients as life inevitably changes. Our role is to continue to optimize their income with the help of their accountant to get the most out of their hard-earned dollars. The fourth consideration when planning your retirement income is utilizing a fixed income strategy or cash wedge strategy within your investments. The purpose of this kind of strategy is to build out a group of assets within your retirement portfolio that will be insulated from large equity swings. Most believe this is the best way to structure a portfolio by means of de-risking from the perceived risk of the equity markets. That said, we all experienced 2022, when rates spiked and fixed income investments got crushed. If you were a balanced investor at this time, your portfolio was in a negative. On the flip side of the de-risking argument is the consideration of keeping the equity portion higher. There was a recent study published through the Social Science Research Network that challenges the two core tenets of typical retirement life cycle investing. Those are that you should, one, diversify across stocks and bonds, and second, that you should reduce equity allocation with age. In this paper, the authors suggest the optimal retirement portfolio is actually 100% equity, with a mix of domestic and international holdings, which lends itself to building wealth, preserving capital, and generating bequests. I will link to this study in the description if you're keen on learning more. While I personally agree that most investors may be too conservative entering retirement, I can understand the reasoning. Retirees can feel uneasy entering retirement, so the psychological benefit of knowing that they have some funds in reserve can provide comfort, especially when markets fluctuate in those first few years. For that reason, there is something to be said for building a small cash reserve or target date bond strategy that can be utilized during market events. So, although the evidence from a purely analytical standpoint suggests a diversified equity portfolio is optimal, for most Canadians, it likely makes sense to give up some opportunity cost to build in a few fixed income or cash instruments into their retirement portfolio. The fifth retirement income consideration is setting up a home equity line of credit before you retire. Most of the people we work with are entering retirement with little or no debt, which is great. That said, I suggest that having access to debt as an option is a very powerful tool. It may come in handy down the line if a large lump sum purchase comes up that you don't have the liquid cash to pay for outright. For the retirement investor who have most of their retirement assets tied up in RRSPs or other taxable accounts, this one is crucial. When a large expense comes up, especially if it's unplanned, having access to debt can be a game changer. Say you needed a lump sum of $50,000 for a planned or unexpected reason during retirement. Looking at your accounts, you have mostly RRSPs. So in your case, you would need to sell, say, $75,000 in your RRSP, pay $25,000 in tax, to net $50,000 in your bank account. If you had access to a line of credit, you could consider a draw from that account that is within your budget and make a plan over time to zero the line of credit. As the old adage goes, it's better to have it and not need it than need it and not have it. A strategy like this can add flexibility, which is crucial to creating a sustainable retirement income. The sixth retirement income consideration is the impact when one spouse dies. Outside of having your wills, powers of attorney, living will, and beneficiary designations up to date and in good order, there are some other retirement income and tax considerations that are best planned for year over year in advance. If the deceased spouse was over the age of 65, old age security stops paying out, and there is no survivor benefit. This is approximately $750 a month of income that is now gone. With regards to the Canadian pension plan, there is a survivor benefit the widow or widower will receive. If you are age 65 or older, you will receive 60% of the deceased spouse CPP if you are not receiving other CPP benefits. If you are under age 65, you will receive a flat rate portion and 37.5% of the contributor's retirement pension if you're not receiving other CPP benefits. If the surviving spouse is already receiving a CPP retirement pension or disability pension, the survivor's pension will be combined into a single monthly payment. However, you cannot receive a full survivor's pension while also receiving a full retirement pension or disability pension. The combined benefit is not necessarily the sum of the two separate benefits. When combining the CPP retirement pension and survivor pension, the most that can be paid to a person who is eligible for the retirement pension and their survivor pension is the maximum retirement pension, which is more than the maximum survivor's pension. So, what does this actually mean as a simple example? If the surviving spouse is already receiving the maximum retirement pension, they will not receive a survivor pension. If they are near the maximum, they may only receive a top-up to the maximum amount. This can result in a loss of hundreds or thousands of dollars in monthly retirement income that has now vanished. While we are on the tune of pensions, many Canadians have defined benefit pensions through their employers. Most of the plans we come across will provide the spouse a 60% survivor benefit for the remainder of their life. That said, there are pensions out there that cover 100% and some less than 60%. It really depends on the pension plan itself and the options chosen by the annuitant. Either way, most surviving spouses can expect an additional 40% haircut on this monthly income stream when their spouse passes away. Outside the loss of these fixed pensions, which for most will be a reduction in monthly income by hundreds, if not thousands of dollars, there are two other key points to address here. The first is the loss of income splitting. For many of our retirees with large RIF accounts, we want to get these funds out at a reasonable tax rate while factoring in other things like CPP and OAS timing, to name a few. Once one spouse passes away, the RRSP and RIF accounts will likely roll over tax deferred to the surviving spouse. The issue now is that the RIF minimum is now calculated as one lump sum and taxed solely to the surviving spouse. This could result in additional taxes payable and potential loss of government benefits like OAS. The key here is to plan accordingly during the tax valley and early retirement. The decisions you make early on in retirement can help alleviate the future loss of spousal income splitting. The second key point to address is the potential loss of the expertise of the spouse. Nearly every household has a spouse that takes on the lion's share of certain tasks. When it comes to personal finances and investments, one may tend to manage more of the day-to-day finances, while the other focuses on the long-term stuff and investments. When it comes to personal finances as you enter into retirement, I cannot stress enough the importance of being on the same page when it comes to finances. Now, I'm not saying the non-financial spouse has to become an expert in the area, but they should have a basic understanding of what's going on. If you are a DIY investor, this will be exceedingly difficult to manage, as the surviving spouse might be a waif, a ship without a rudder, not knowing where to turn, which can leave them vulnerable. For those of you working with an advisor, be sure to work with someone who actively engages both spouses in meetings. Personally, nothing annoys me more when I enter into a meeting and the person sitting across the table does not look at or actively engage my wife. It's nearly always an automatic no from my wife and I in those scenarios. Anyway, I think this point is so incredibly important, so much so that if you go through our fundamental retirement plan process, we will not proceed with our planning presentation if both spouses are not in attendance. All this to say is my last key consideration, number 7, the advisor's role in retirement planning. As you've probably gathered by now, retirement planning can be a bit technical. This might sound grandiose, but I believe that retirement planning is just as much of an art as it is a science. Yes, there are planning software that we use during our planning process to ensure due diligence and accuracy in our recommendations. But life is messy. Uncertainty persists and plans derail, leaving us with the only true constant: change. Building a plan in planning software gives you a linear journey, whether it's returns, spending, inflation, or more. Thankfully, most planning software utilizes what-if scenarios to stress test a financial plan against market downturns, health risks, and more. This is a crucial exercise to go through to give clients the confidence to retire in a future that is yet to unfold. When you hear me talk about investments, you've probably heard me say that no one has a crystal ball, which lends itself to our team utilizing low-cost, evidence-based solutions and not trying to predict what will happen with the market. Rather, we focus on robust financial planning to give you the confidence as you take the next step into retirement. The art of retirement planning is in the nuances of our discussions and the delivery of the strategies in plain English, repeated consistently and ready to pivot at a moment's notice. Okay, so that'll do it for today. Here are your action items for today's episode. First off, down in the description box, there are a few resources for you to check out. The first is the study I mentioned in the episode, and the second is our client service standards. I often get asked, what does my financial planner actually do? Or shouldn't I just ask my accountant those types of questions? This document should help answer a few of those questions that you may have. Second, if you're within 5 years of retirement, now is the time to start laying the foundation for a sustainable retirement. Many will push off this decision and wait until they're within a year of retirement to engage with a financial planner. But I would encourage you to start the process early, as there are some strategies you will want to consider getting set up well before your actual retirement date. Lastly, I want to personally thank you for making it this far and listening to this podcast. If you've listened to me for a while now, you have picked up on how the episodes are structured nearly identically. To be open with you, this is how I structure most of my life and our business. Consistent, repeatable, dependable. If you're enjoying this podcast, please share with a friend and leave us a review in your favorite podcast app. Okay, so that'll do it for today's episode. Make sure that you are following us on all of our socials. Be sure to sign up for my weekly Retiring Canada newsletter. And hey, when it comes to your retirement, don't take chances. Make a plan so you can retire with confidence.
All comments are of a general nature and should not be relied upon as individual advice. The views and opinions expressed in this commentary may not necessarily reflect those of Harbourfront Wealth Management. While every attempt is made to ensure accuracy, facts and figures are not guaranteed. The content is not intended to be a substitute for professional investing or tax advice. Please seek advice from your accountant regarding anything raised in the content of the podcast regarding your individual tax situation. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning.